Okay, I did a video a couple of days ago just showing how you could apply the beta indicators, that's beta sine wave, beta momentum, and beta pro-am, to the futures forex market as a way of getting all the kind of volume related signals that are part of the beta indicators. And I got an email from Paul just saying, is there a chance that you could look at the 5-year Treasury futures the same way you analyzed the forex futures? He also said it was very interesting, so that's nice. And Paul, yes, I can show you that, and I'll just walk you through the same steps that I took the other day. So this is kind of a useful technique to just see what kind of tick bar settings you should use on the different markets. So I start off here with a 24-hour chart of the E-mini continuous contract. So in TradeStation, this is at ES, and 1440 minutes is 24 hours. And what I've plotted, just show you on the formatting of the symbol here, that instead of volume, I'm using tick count. So for volume you've got two choices here, trade volume or tick count. So in this case what I've chosen is the tick count intraday for a 24-hour chart of the E-mini. And what you can see is over the last couple of months we're kind of averaging around 500,000 ticks or trades per 24-hour period. And that just gives me kind of a rough rule of thumb, which says my lowest time frame then is a 500 tick bar chart, and then I'll multiply by 3 to get 1500 for my intermediate time frame, and then 3 again for 4500 for my highest time frame for day trading a particular market. So you can use the same kind of methodology to look at the different bond markets. So let me just spin through these just quickly. So this is exactly the same chart, exactly the same setup, and in this case we got the 30-year bond contract at US in TradeStation. That's 1440 minutes again, exactly the same kind of volume chart. And you can see that on average with the 30-year bond contract, the kind of volumes we're getting in terms of trades today is trades per day is, let's say, about 50,000. So it's 1/10 the size of the E-mini contract. So it's about 50,000 contracts per day, 50,000 trades per day. And then the next bond market to look at is the 5-year bond market, sorry, 10-year Treasury note market. So this is the at TY market, and here again, if you look at the volume histogram down at the bottom, this is just the canned volume indicator from TradeStation. You can see again we're kind of averaging maybe just a little bit over the 50,000 contracts per day. And then lastly, this is the 5-year note, so the at FV contract, 24-hour, exactly the same chart, and again you can see it's also averaging about 50,000 contracts per day. So if 50,000 trades per day, I beg your pardon. So if the E-mini is doing about 500,000, 500,000 trades per day, and each of these bond markets is doing 1/10 of that, 50,000 trades per day, then the lowest kind of time frame setting for day trading that you'd have would be a 50 tick chart. So let me just pull that up. So this is because Paul was interested in the 5-year Treasury futures market. So let's pull that up. This is at FV, and this is a 50 tick chart using the beta sine wave indicators. I've just got beta sine wave kind of just below the fold here, so you can't see it on this chart, but we've got beta momentum down below the price bars. On the price bars with themselves, we've got the support and resistance lines that are being drawn by beta sine wave, and then we've got beta pro-am with the professional and amateur bars, and you can see the amateur bars are in yellow, professional bars in blue, and so on. And you can see, so on a 50 tick bar chart, it's kind of live at the moment, you can see beta sine wave is catching the highs and the lows of this kind of consolidating market at the moment quite nicely, so doing a nice job there. You can see the professional and the amateur kind of activity at the bottom of ranges, tops of ranges at turning points, and so on. The problem with, and you can also see the exhaustion selling here. So coming into this, this last day, exhaustion selling on the downside, bullish divergence, kind of bearish divergence pattern and stuff. So everything's kind of working quite nicely. However, the types of ranges and moves that you see this on a 50 tick bar chart is really pretty limited. Although it does give you a good indication of what's happening kind of during the day. I would maybe suggest that you kind of go up a couple of time frames. So, if the lowest kind of tick bar charts that you use is a 50, 150, and a 450, then so starting, if this is the lowest and then times 3, again, your highest time frame there would be a 450 tick bar chart. I actually think if you look at the start there at the 450 tick bar chart, so you kind of more rather than day trading the bonds, you'd be more and you're not quite swing trading the bonds, you're kind of somewhere in the middle, kind of holding overnight. And I think that's probably a better strategy on the bond market rather than kind of day trading the bond market. You might start with the lowest time frame being 450 ticks. Then the intermediate time frames would be 3 times that, would be 1,350, and then 3 times that would give you a highest time frames, that would be a 4,050 tick bar chart. And so let me just show you that. So we'll keep to the same 5-year bond contract at FV here, and this is therefore that kind of highest tick bar kind of time frame, and that's a 4,050 tick bar chart. And you can see, so each of these grey dotted vertical lines are showing the close of the day session, and you can just see what's been happening over the last 2 weeks, 2 or 3 weeks here. You can see we had a bottom made here, we kind of broke into an uptrend, we had a pullback and an uptrend and an end of trend warning signal. That was made after we had kind of exhaustion buying taking us through there. This end of trend warning signal was made with a bearish divergence pattern on better momentum. All this professional activity here kind of taking profits. And then lo and behold, here's our second cyclical turn after an end of trend warning signal, which I say I always look to for kind of change in trend signals. And right at the high here we have 2 little Rambo patterns, these little R's here. Rambo is a reversal of a Lamitar breakout potentially, and that's kind of an old friend of mine, which is just showing the breakout here is being driven by the amateurs right at the high here. They get wrong footed, the market turns and goes the other way, and we kind of step back down into a downtrend move here. So here's this on this highest kind of time frame chart on the 5-year treasury market, just showing how exactly the same kind of patterns that we see in the E-mini market and all the commodities markets, all the stock markets, works for the government bond market as well. And it's one of the things I've learned the hard way about kind of optimizing indicators, over optimizing indicators, and there's virtually no optimization in the better series of indicators. The better sine wave indicator based on price is calculating real time the changes in cyclicality of the market, and so it's adjusting all the time for kind of different market characteristics, if you like. And then better pro-am and better momentum, again, I mean, there's a look back period there that's kind of changeable for exhaustion settings, but apart from that there's no kind of optimization going on. So I just apply these to any markets and any time frames, and that's kind of the objective. As long as there's kind of volume data, these indicators should work. And there we go. I think that kind of shows quite nicely that they're kind of working there in the 5 years. So let's have another look at the 10-year here, just as a similar kind of example. Similar kind of patterns. I mean, the bond markets do move in different, in sync to some degree. The 5, the 10, and the 30. So it's not a surprise that we'd see a similar type pattern in the 10-year market. So again, we have exhaustion buying at this point here that coincides with an end of trend warning signal. Coming up into that turning point, we've got profit taking and stopping volume that happens before the turning point, which is what you see in the kind of volume patterns. And then after the turning point happens, you see a no demand pattern, which is kind of just waiting and seeing and what the market kind of turns. And then the market just consolidated, starts to turn up here, and you can see the professional activity was selling into this uptrend here. They kind of bought the breakout into an uptrend here. They kind of sold these highs. They caught the lows here, but sold the lows again. And then you can see here, so second cyclical turn after an end of trend warning signal, and then we get a final little push. But at this little push, you can see all the professional activity, blue bar after blue bar here, coming into this breakout into above the channel. And then right at the high, we've got a no demand signal, and there's the amateurs kind of playing right at the high, thinking that this thing is going to the moon. Doesn't, reverses, goes the other way. We kind of break into a downtrend, kind of away we go. So again, same kind of signals, and just wanted to show you, I'm very keen on this cyclical activity and trendy activity in lower time frames. So this high that was made between July 21st and 22nd. Let me just back down to the lower time frame, which will be the 450 tip bar chart here, and this is between the 21st and the 22nd of July, and you can see on the lowest time frame here, yep, that kind of blow off exhaustion signal was signaled with a break above the end of trend warning signal here. But all of these kind of volume distribution signals, we had a